Hi everyone. In this video I will show you my general workflow in order to optimize and testing trading strategies. For the optimization part, we will see the main performance metrics you should optimize for, my general recommendations for finding the best parameters, and how to evaluate their robustness on your in-sample data through sensitivity analysis. Then we will see two approaches for calculating your out-of-sample returns and how to perform statistical tests on them to evaluate real life performance expectation. So the basic concept of developing trading systems is to split your dataset into two or more folds. So in the first one, which will be your in-sample data, you will tune your system and study the market behavior. And then on the second one, which will be your out of sample, you will test to see if the pattern you identified is actually real on new data. So when you have a trading strategy idea, the whole optimization process comes down to three steps. So first, you define your parameter ranges, which should be realistic and not too fine. So just define a coarse grid of parameters. Then you will choose a performance metric, which we'll see later. And you will use an optimization algorithm to explore the parameter space and hopefully find the best combination. This, of course, is done only on the in-sample data. These are the main performance metrics. So a Sharpe ratio, of course, rewards high and stable returns. The Sortino ratio penalizes more for negative returns. The profit factor compares the gains versus the losses. The Kalmer ratio compares the annual compounded growth rate against your maximal drawdown. And your Ulcer index looks at the duration and depth of your drawdowns over time. So the first thing I like to do when looking at the performance is just not to look at the best performer overall, but to look at the distribution of every combination tested. So we can see in this example, the distribution is centered around 0.5. So we know that most of the combinations we tested led to a profitable outcome. Of course, this can be biased because if I just put into the model only the right parameters, it will give positive returns. But as I said before, you should aim for a coarse grid and realistic parameter ranges. Another thing I like to do is, let's say we tested 1000 combinations. I will group them into clusters to identify the general tendencies of parameters that tend to work. And I will find for each cluster a specific parameter set actually tested as the closest to the centroid of each cluster. Finally, we can execute our optimization process over multiple folds to see if what works in one period of time remains stable throughout the other folds. Up to now, I talked about the best solution, but what is actually the optimal solution? So the problem is that the more degrees of freedom our system has, the more it will overfit the data. So our optimal solution isn't just one lucky combination of parameters, but is something that is robust over slight changes in both the data and the parameters themselves. That's why after you found a reasonable solution, you should test the sensitivity of your system in regards to the parameters. This is done by slightly changing each parameter one at a time, leaving the other untouched. And you will see that the robust systems will have smooth and flat curves, while overfitted ones will drop from one step to the other. So in this example, we can see that the value of 18 has a lower performance than 22, but has a much smoother and flatter region, while 22, going one step to the left, almost halves in performance. Once you found your best and hopefully robust solution on your in-sample data, it's time to evaluate your system on new unseen data to see actually how it would have performed in the real markets. So there are two ways of doing this. The first is just to split the data one time and evaluate on the following split. This is good for fast screening of multiple strategies or when you have little or limited data set, and also is good for very simple strategies, which is likely less to overfit. Then you will have the walk forward analysis, which is more realistic for estimation of real life performance, because in real life you will tune your system on, let's say, the last 3 years of data and leave it untouched for 1 year, for example. And by replicating this, you can kind of simulate the whole process for a longer period of time. Also, it can test different market regimes, which is good for evaluating the robustness of your system. And finally, it can unveil if you have stability or not of your parameters over time. On both cases, you will end up with a series of out-of-sample returns, which will be your only unbiased estimate of real-life performance. So one test you can do on your out-of-sample data is called Bootstrap. So the concept is that your out-of-sample returns are just one of many possible realizations from an underlying distribution of returns. So assuming that what you observed as distribution is similar, at least to the true one, we can use Bootstrap. So we're just picking random sample from that and doing that multiple times to simulate alternative scenarios. So from these Bootstrap returns, it's possible to estimate confidence intervals for your performance metrics such as Sharpe ratio or max drawdown. Another test we can do is called permutation. The concept is that your observed equity and statistics are depending on the order upon which the trades or returns are observed. So basically, by doing permutation, you're shuffling these returns or trades, and by doing many simulation, we can see the actual probability of having faced severe drawdowns given the same identical returns. As an example, we will see a triple moving average crossover. So basically, this low moving average is a trend filter, so we'll only enter long when the price is above this moving average, and we will enter specifically when the fast crosses up through the medium. So our starting parameters are 10, 20, and 50, with the ranges between 5 and 20, 20 and 40, 40 and 100, with a step of 5 and 10. So it will be coarse enough. Then we will have a ATR multiplier for the stop loss set as 1.5 and a risk per trade of 1%. So I loaded the data from Nasdaq on 1 hour time frame from 2020 to today basically, and as you can see, I already took up a out of sample dataset of 30%, and now we are using currently the in sample data. Now I loaded the strategy on the data, and we can see the entry signals right here. So for example, here we have our price above our slow EMA, and the fast one is crossing up the medium. So we have an entry signal here and an exit signal here when it crosses below. We just run a very quick backtest without commission to see the general performance of the strategy. And actually we can see it has a good performance with 1.25 Sharpe, Calmer of 1 almost, and Ulcer index half the one of the benchmark. So now I'm going to optimize the strategy for a maximum Sharpe ratio. And as you can see, I'm splitting the in-sample data into 2 more sets. So I'm gonna have a 25% of training set, so we can evaluate the best performers, which are 50, but I'm gonna set 100. Also on the out of sample of the in sample, okay? So now I run, and it will take a while, so I will see you in a minute. So the optimization is complete, and first of all, we see in the histogram here, in the blue, we have all the combination tested, so we can already see that all the combination are actually profitable, and in purple, we see the top 100 combination out of sample. So we see that actually the mean of Sharpe ratio is actually 2 of all these top performing parameter combinations in sample. Then here we see the equity curves, both in sample and out of sample of the 100 combinations. And here we can see the max drawdown, where this is all the combination tested and these are the top 100 in sample. Then here on the left, on the tables, we can see the actual parameter combination, which we're not interested to see right now. And if we want to check the metrics for every combination, but we can see that, for example, for the first 5, etc., out of sample, the performance is really good. Sharpe ratio around 2, more or less. And still, this is without commissions, so we have to see if this holds with commissions. Now that we have our top 100 parameter combination, we are ready to cluster them using k-means in this case and ordering for Sharpe ratio. So we run the algorithm and it just finds 2 clusters based on silhouette score. So we have these 2 parameter sets, which we can test individually in a moment. So now I'm actually modifying the strategy to set these parameter sets. So we have 10, 35, 80, 15, 10, 35, 80, 15, and 1.5. Then we reloaded the strategy here, and we can see its performance right here as 1.6 of Sharpe ratio and 1.2 of Calmer. So now I'm going to load also the second cluster parameters and check also its performance, which is even better actually. It's like a straight line without commissions always, but it's very good performance considering that we trained the parameters on this portion of data and this is the out of sample. Now we can actually test the parameter robustness around this local optima. So I'm going to test for 5 steps on each side of the parameter and we will now see the results. Okay, so we can see that the strategy is pretty solid around these values because we don't have like a very sharp drop from one value to the other. The only thing we can notice is that maybe using an ATR multiplier stop loss smaller could lead to better results and also a greater slow moving average, but this does not increase the performance by much. So we're going to keep this variant and test it out of sample. So now we're using these parameters, okay, and we are going to switch to the out of sample data, which is from 2024 up to today. So we're going to apply the strategy here and finally evaluate out of sample. And surprisingly, we see that the strategy is not robust out of sample, even though in the other out of sample fold looked more robust than here. Now, for the sake of completeness, let's test also this parameter set. So we have 10, 35, 80, 15, 10, 35, 80, 15, and 1.5. So we're going to use the out of sample, of course, apply the strategy, reload, and evaluate out of sample. So as we can see, the performance is not super exciting, but is still better than the other parameter combination. So I performed a Monte Carlo Bootstrap simulation on these out-of-sample returns, having a number of simulation of 1000 and for 1000 bars with a confidence level of 95%. What we obtained is that the Sharpe ratio could be between minus 0.4 and 2, which is decent. And the max drawdown, for example, is between minus 30 to minus 8. So now let's do the same with permutation testing we saw before. And as we can see in this case, of course, the Sharpe ratio is the same as the profit factor, but metrics such as Calmer and ulcer index change because the max drawdown is different. So we have a max drawdown with the same traits we had between minus 20 and minus 8 with the same returns distribution. And here in our backtest, we had like minus 17%. So we had actually one of the worst we could experience with this distribution. So now if we want to do things a little bit more seriously, we can do a walk forward analysis. So we will use a 3-year training window, and we will retrain our system every year. And for this case, I'm using basically 90% of the dataset. So this is going to be the in-sample data. So I run, and the system will optimize as we saw before, and it will pick the best performer of the in-sample train window, validate it on the out-of-sample data, and then retrain everything every year. So here we have the result, and actually it's very good. So we had 4 splits in total, so from 2023 to 24, from 24 to 25, 25 to 26, and from 26 up to today. And we can see the performance is very good actually. So we got a Sharpe ratio of 1, Calmer of almost 1, pretty low ulcer index, and decent profit factor. So again, this is a more realistic estimate of our out-of-sample returns, and we could move on for further statistical tests on these returns, but we're not doing that. So I'm gonna end this video here, guys. So let me know what do you think in the comments, and maybe let me know what would you like to see next. And that's it. See you in the next one.